So on the money side, you've got gold, right? And gold has appreciated from 1900 whatever year ago to now almost 2500 today. I think it's going to go to 3000 after the election. And I think it could go to 4 the end of next year and 5 probably the end of 2027.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today, we're fortunate to have with us Dr. Nomi Prins. Nomi Prins is a PhD economist, geopolitical financial expert, best-selling author, and serves as an unwavering advocate for financial reform and foundational economic growth. Her career path is a testament to her versatility, having held key positions on Wall Street as a managing director at Goldman Sachs, a senior managing director at Bear Stearns, a strategist at Lehman Brothers, and an analyst at Chase Manhattan Bank. Nomi is a trusted, independent advisor to U.S. legislators on both sides of the aisle, nonprofit organizations, corporate boards, and universities. She also shares her thoughts and insights on her Prinsights substack. Nomi, thank you so much for joining us today.
Thank you so much for having me on.
So let's begin with your current assessment of the economy and where you anticipate things going over the next 6 months or so.
Yeah, so it's interesting because the U.S. economy just had a print of 2.8% growth for the last quarter, following a 1.3% growth which was revised down from 1.6% for the first quarter. And that was touted as, okay, well, the economy's back and chugging again. I dig deeper into those figures in general, and most of that 2.8% growth, first of all, if you adjust it for inflation, it's anemic growth. But if you leave inflation out of the picture even, came from personal consumption data. And personal consumption right now is predicated on two main things. One is debt, because consumers are at record levels of debt, and they're also record levels of debt payments, of servicing on that debt. And on the other side, a depleting savings rate. So the savings rate over the quarter dropped from 3.8% to 3.5%. And the amount of total savings in the United States dropped from 770 billion to about 730 billion. Now, in and of those in themselves, each thing in isolation is not a major problem. But when you start to see more debt, more cost of debt, less savings, depletion of savings, even incrementally, it starts to paint this picture of just a really strapped consumer. And so if it's the personal consumption that's driving that particular uptick in GDP, it's just not sustainable. So I think we're really at an under 2% GDP growth, which if you adjust for inflation of about 3.5%, or even it comes down, is a negative growth pattern. Now, this is not new either. We saw a fairly tepid GDP picture before COVID. Obviously, things were closed at COVID. It jumped afterwards. But this is pretty much where the U.S. is at. It's at a very sort of flat-lined growth situation.
It's interesting because the data is being supported by Wayfair, McDonald's, Big Lots, Walgreens, all of these companies that are supporting the consumer, the general consumer, not the high-end consumer. They're all struggling, every single one of them.
Right.
So, Nomi, yesterday, Fed Chair Powell stated that rate cuts in September are on the table if inflation data continues to cool. The 10-year bond has often been viewed as a good proxy for interest rates. The 10-year dropped again and is now below 4%. It almost looks like the market's going to cut rates for the Fed this time. In your analysis, is now the time frame that the Fed will begin the cutting cycle, and what will that mean for the economy moving forward, precious metals and energy?
Yeah, I do believe they're going to take a little toe in the water cut in September. Like the rest of the market is basically starting to project more so. I had actually thought last year that by this late summer, early fall period, they would have to start to cut because growth would start to slow. Now, you and I weren't talking last summer, but that's basically where I was at and where I was publicly at. And because our growth has slowed and inflation has taken a cut out of that, and inflation is still positive. It's lingering. It's just slower. And which just means prices are still rising, but more slowly. And so when Powell talks about inflation, I mean, he's still really trying to stick to this narrative that the Fed somehow has controlled this, has like landed this inflation plane, not quite yet. So we got to wait a bit. We got to watch the data. It'll happen. But the reality is, inflationary pressures that were super high in the wake of COVID because we had supply chain disruptions that were so massive, and some of them are still overhanging and actually opportunities in the metals market, which we can talk about. But they were what really pushed up inflation when things started opening with reduced supply, harder transport, less logistics, everything kickstarting. It took a minute. It strained prices, it strained supply chains, it strained the cost of things, and that worked its way through the system. I personally believe that had the Fed done nothing with rates, we'd probably be about at the same spot we are at right now in inflation, give or take a little bit. And what does that mean? That means it's lingering. That means Powell can choose to or not choose to recognize that. He can choose to or not choose to look at the fact that I think the next growth print will probably come down, but not necessarily in time for the Fed meeting. But what will come down, I think, is the employment picture. In other words, unemployment, I think, will rise above the 4.1% that it's at. We're seeing signs of that in some of the smaller communities, rural communities, some of the manufacturing areas throughout the country. We are seeing strains in the labor force. We're seeing concerns coming out of some of those working forces, and obviously we're seeing layoffs. And so the picture of unemployment has ticked up, has gotten worse throughout this entire time. Powell just chooses to, I don't know, not acknowledge that. And one meeting is talking about inflation, one meeting is talking about hot labor market, whatever it is, to try and get that sort of perfect. I was just watching the Olympics, but like stuck landing on the mat, and it's like he can't really control all of these factors. So therefore, I still think he's going to have to go with some sort of incrementals or small cut, just because inflation's not really under his control. It's just down enough, growth slowing, unemployment rising, and just to basically not get caught out if the economic picture starts to decline more rapidly.
Some would say he's done a magnificent job of jawboning, though, this whole time. But I think your point about unemployment is spot on. It's actually my next question. The ISM jobs index data came out today. I don't know if you saw it, but it cratered to 43.4 from 49.3. This was the weakest employment reading since June 2020 during the height of the pandemic layoffs, and actually lower than it was in September of 2008, which was 45.4 when Lehman Brothers collapsed. So during the pandemic, everyone was quitting jobs. It was termed the Great Resignation. Things have changed dramatically. No one's quitting now. It's now called the Great Stay.
Right.
Now is a really tough time for people to find a job. Right. Unemployment has a cycle to it, with the average between bottoms being about 6.8 years. It's currently closer to 15. After bottoming each and every time, unemployment typically goes straight higher, and the average unemployment increase over the last 12 cycles, dating back to the 1940s, Nomi, is 3.6% of an increase. So a 3.6% average increase would put unemployment in the low 7, maybe medium 7% range for this cycle. Is that what you're expecting? And what's the impact of a 7% plus employment on the everyday man and woman here?
Yeah, I mean, I think a 7% plus on the main headline unemployment, and then there's another figure, the U6 figure, which actually shows unemployment on participation weighted basis. But that would be very high. That would be very worrying. I don't know if we get quite to that level, but I do see us in the sort of 4.5 to 5%. That's where we're ticking up to right now over the next year or two, and even that is a strain, because against that backdrop, you have this, again, lower savings rate. People have less money in their bank accounts. The cost of debt has increased. The cost of servicing on that debt has increased. So you have all these other straining factors. And if you add into that the anxiety of either losing a job, having to stay in a job that doesn't really pay the bills or whatever it is, that becomes really significant to the worker, to basically the average citizen. And so in terms of how that plays into overall economic growth, of course, that cuts back on our ability to spend and to grow internally, to grow small businesses, to basically borrow to develop. I mean, all those things can impact them.
So we're already running, close to $3 trillion deficits. If we end up with an unemployment picture, pushing 5% or higher, whatever, if it reaches the average garden variety, as Stanley Druckenmiller points out, recession, what happens to the tax base? What happens to the deficits? What are we looking at?
Well, right now, the deficit, yes, it continues to increase. There's no real plan in Washington, and I say that on behalf of looking at both parties. This is not a partisan view, to really do something to grow the economy. Now, there's a lot of talk about, should we cut this, should we cut that, where taxes come into play and stuff on both sides of the aisle, but there's no real plan in terms of how are we going to grow relative to our debt. Our debt, which is top $35 trillion right now, is substantive. It's the highest debt to GDP ratio a country has ever had, short of World War II. And it doesn't look like it's going to diminish anytime soon. So the deficit, a significant part of the budget of what the U.S. has to pay to just before it turns the lights on out of pocket, is topping $1 trillion a year. So it's, the forecast was for $880 billion for 2024. We're already sort of increasing above that forecast going into this year. And the expectation by the BAE, is that it will be $12.7 trillion worth of interest payments on our debt over the next decade. That is like running a lot of major small economies. So forget the size of the debt, just servicing the debt is a massive cut. So if you have that kind of drain before, and if you're an individual, you know this because if you have to pay your credit card minimums and they're mostly taken up by interest payments on your debt, you know that is a really horrifically choking financial feeling. That's what the U.S. is doing on a sort of grand scale. It does increase the deficit. So if you have less taxpayers paying into the system, then of course you have more of a gap between the tax receipts that go into that entire equation versus the debt payments and versus everything else. And it becomes a really, a very ineffective way of I don't want to say the government's running the economy because they're, but creating policy to enable the economy to grow, it becomes very difficult.
So, Nomi, a lot of people want to know that, does this really even matter? Does it matter in the grand scheme of things? They've been able to kick the can down the road for so long. They've been able to, avoid having some debilitating effect from this huge and growing debt, from the debt servicing, et cetera. I know it's gotten so much huger in the last 4 years because of the higher interest rate and because of the exploding printing and the, resulting in the higher debt. But the people want to know, does it really matter in the end?
Well, from the standpoint of can the U.S. continue to borrow forever? It can. Can the U.S. Continue to pay so much money and increase its deficits by such a substantial amount before it does anything else? It can. I mean, this is, but whether that is a good thing or not, whether that's productive, whether that is competitive, these are the bigger questions. Our debt has been questioned in terms of whether it's AAA quality or not, and whether we will default or not. But the reality is, as long as the dollar, which it is declining, but as long as the dollar remains the reserve currency and the sort of currency of choice for trade, and again that is changing, but in our lifetimes it will probably remain so. There will be a need for U.S. denominated securities, and the Treasury Department will have a place or places throughout the world that will buy them. Now, that said, they're buying less of them. And so for example, the People's Bank of China, they've been in Bank of Japan have been major central bank supporters of U.S. debt, but the amount of debt that they have on their books has actually stayed the same to decline on an absolute basis, and on a percentage basis to the amount of debt we have created in the last few years, it's declined significantly. They're replacing with gold and other things in terms of their reserve makeup, but all of this is changing. What does that do to the United States as a country? It makes it less competitive. It makes the cost of goods that we import, even if we try to do things on a taxation or tariff basis to sort of level the playing field, it just makes things more expensive to the average consumer, and that creates more of a pinch, and that just creates this ongoing feeling from election to election cycle, because we're in one, it's around the corner, of just strain. just financial and economic strain for the average family.
It also begs the question, in the event that the Fed needs to come in with some helicopter money and, China and Japan and others aren't there, what happens? I mean, is the only alternative that they have to monetize the debt?
They can legally, just from sheer logistical perspective, print money when and if they need to print money, and however it is they deem it necessary. We saw a little bit of this sort of undercover to an extent last March, when we had a number of regional banks fail in the United States, and the Fed, even though it was in a tightening mode and it was in a quantitative tightening mode and it was raising rates, decided to print $300 billion just to sort of ease the tensions a bit in that whole situation. So they can at any time, and the major central banks can at any time. Not all of them. It's much more difficult if you're, sort of a regular country that doesn't have the ability to use your currency in a lot of trade or as a potential reserve to issue debt. But we can, and the Fed can buy it. So it's not an accident that as our debt has increased, the Fed has also increased its book. Now, recently, the debt has continued to increase, and the Fed has been decreasing the size of its book, but it's still like over $7 trillion. It's still a significant book. And so it can go higher if there is a reason. If we have a major banking crisis, a major geopolitical crisis, whatever, there is no law that limits what the Fed can print, and therefore how much money the Fed can divert to buy treasuries.
So in the current macro, geopolitical, economic, and market environment we find ourselves in, what should real tangible assets mean to investors everywhere, and why should they be paying close attention to this sector?
Yeah, that's a really great question. I think that when you look at global economics, even if certain countries slow down, there are other countries that pick up the slack. So even if the US is slowing down below 2%, inflation adjusted, it's flat, and China's slowing down a bit, inflation adjusted, it's still positive. Wherever you look in the world, there are things that are being developed, there's infrastructure that's being created, there's energy transformations that are in play that will continue to play out. And there is a war for what's underneath the ground. There is a geopolitical, national security related war to what is needed for whether it's semiconductor chips, whether it's permanent magnets for satellite defense systems or our iPhones or whatever it might be, and to try and control and contain a bit of that supply chain and the cost of that for each individual economy. So one of the reasons that the White House under Biden did what the White House under Trump did, which was increase its tariffs relative to China. Part of that was to try and sort of contain, and some of it worked and some of it had the opposite effect, the supply chain coming in from China into the United States. Of course, China continues to hold a lot of the supply chain. For example, rare earth minerals. It holds 60% supply chain, 90% of the processing chain. All that stuff goes into our phones. All that stuff goes into our cybersecurity systems. It goes into our EVs. I mean, so there's just a lot of this juggling going on as well. And so where are the real assets that are driving this, and why? Well, they kind of come into three categories, I think. We call them precious or real or critical or whatever. But if you look at a different way of categorizing them as well, you have the assets that are related to currency allocation or diversification. Then you have the ones that are related to energy, and then you have the ones that are related to technology. That's another way of looking at real assets. And by real, I mean things that actually come from the ground that are needed to build products that we actually have to use, and that we do use, and that we're going to increasingly use and develop, because that is the trend. So on the money side, you've got gold, right? And gold has appreciated from 1,900 whatever year ago to now almost 2,500 today. I think it's going to go to 3,000 after the election. And I think it could go to 4 the end of next year, and 5 probably the end of 2027. It's not going to be like a massive high spike in 1 second. It's going to be slow trend upward, like as we have seen with volatility along the way, which doesn't mean everybody's forgotten about it. Why? Because it has use value as a currency hedge to the dollar for a number of central banks around the world, from India to China to Turkey to a lot of the developing central banks. And 2, because it has been seen to have some inflation hedging properties, but also more people are becoming aware of it for just a generational wealth hand down. Right, so you have a lot more retail investors who are hearing about gold, buying gold, looking for ways to buy gold, a lot more ETFs that are coming into play and so forth, all of which has helped to elevate, in addition to central bank buying, which will continue the price of gold. Gold miners have to an extent underperformed relative to gold, but at some point that gap, there's a value gap there that I believe will shrink. Silver in that same thing. Now, silver is interesting because silver does all of those things, except it's not a big purchase by the central banks right now. But the more expensive gold gets, and the more central banks want to continue the path of diversifying against the dollar, at least in their portfolio as reserve assets, the more interesting silver will become to an entire group of people in running these central banks that have not been paying attention. The last time silver was paid attention to, and they can buy silver, was in the 1920s. That's when you had India buying, Central Bank of India, you had Switzerland, you had all these central banks that right now also buy gold, buying silver back then, the Bank of England, and they can. So they have that ability, that's potential. Also, and of course you have conductivity, better electricity, and the energy transformational aspects of silver. So I think those are just long-term assets that will continue to appreciate in value relative to whatever volatility is happening. Are they going to double overnight? No. Will they appreciate over time? Yes. Then you throw in another energy one, which is uranium, which is a very geopolitical real asset. The world re-embraced nuclear energy since Russia invaded Ukraine, from all aspects, from a nuclear power plant, from a nuclear technology, and from a uranium seeking of supply chains. The United States passed 4 major bipartisan bills, which is very difficult for the United States government to do. They fight a lot. None of this was sort of brought up in the mainstream media because, nuclear energy, nuclear fuel security, whatever. But there are 4 major acts that passed: nuclear fuel security, the ban of Russian uranium bill, the Advance Act, which funds nuclear technologies like small modular reactors and micro modular reactors, which brings nuclear power into localities more cheaply with more waste management. And so these, and then another one was passed in the defense budget. These things matter because they redirect policy funds, which redirects investment funds to using uranium on a domestic and allied basis in respect of the United States, which increases fighting for uranium elsewhere, because we're in one global world, and also nuclear energy. So that's a real asset to pay attention to. It outperformed gold, silver, and copper over the last year. And then finally, rare earths are like the sleeping, kind of going to take a long while to really reach their trend. But there's a lot of, again, bipartisan, multi-party support in the United States and around the world for supply chains of rare earths, because they drive chips, they drive cybersecurity, they drive defense systems, they drive the space programs, and they're going to be necessary to sort of take out of that sort of Chinese purview and disperse throughout the world. So those are 4 different areas where, well, 3, but silver and gold have different use values that really should be a part of anybody's portfolio.
Well, so you touched on each of those areas, and I actually was going to ask you a question on each, so I'm going to avoid doing that, and I appreciate all the information you just provided there. Is there a specific real asset class that really has your close attention right now, and why?
Well, so I am very closely aligned with uranium, with nuclear, and why? Because all of those technologies bills, they've just basically been put into motion. They are bipartisan. I think they are going to grow. There's a lot of new plants that are being restarted in the United States and throughout. There's a race to do that. Therefore, there's going to be a race for high quality uranium. So I'm very and always going to be paying attention to that market. And I was when uranium was at like 30, and now it's 80, 85. It got to 100 and down. So that's one.
Are you more bullish on the miners or on the metal itself?
On both, actually, but when looking at miners, this is actually true of gold and anything. It's important for me when I look at miners to look at what their relationships are to the communities in which the mines are, what their protocols are with respect to sustainability and waste management and cleanliness, and how their relationships are with communities. Because what happens is that in mining, things can go wrong very quickly, from a regulatory perspective, from a licensing perspective, from a locality perspective, lawsuits, etc. So I look at miners as well, but in areas where, miners that actually watch all those things themselves. So both. I think the price will go up. I think the miners that do these things will go up, and the miners that don't will be left behind. So it's the same thing in silver. It's the same thing in gold. That I think it's more and more important that supply is coming from areas where there's just perceived stability, whatever that looks like. And with me, that also includes, or what I look for, that also includes sustainability in technique and the environment and everything else. I think those things are important.
Yeah, that makes all the sense in the world, and I agree with that. So this has been an incredible conversation, Nomi. Before we wrap up here and I ask you our final question, I just want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us. Also, I'm positive that you've enjoyed this conversation with Nomi as much as I have. Please let her know by hitting the like and subscribe button and leaving a comment below the video. It's now time for our Golden Nugget segment. Nomi, let's discuss portfolio positioning based on everything that we've discussed today and with your experience and worldview. As a backdrop, how are you positioning for the next 12 months? What assets do you like aside from, gold, silver, uranium, and rare earths? And what assets do you absolutely want to stay away from?
Okay, so yes, I like all those assets. They are all in my portfolio. I also do keep some cash on the side just to ensure that I can sort of meet a cycle. And I also like some of the AI companies that have the government contracts that are working on sort of data security and data quality and cybersecurity, because I think all of those things are very important in terms of infrastructure, energy technology, defense, and so forth. So I do look at those from the standpoint of AI technology. And I have some of those names in my own personal portfolio. And I'm also looking at some of, actually, and this is based on some new legislation that, or directive that are passing, and I believe will be bipartisan. I'm also looking at ports and sort of shipbuilders. I think that what's going on from the roots will also be part of this sort of global reallocation of superpowers and partners and all of that. So I think just as a sort of side out growth area that's going to be buoyed by policy, that's one that I've just recently become interested in.
Is there anything is a hard no for you that you're staying away from?
Yeah, I mean the banks. I really and we didn't touch on it so much, but look, we are seeing delinquency and default rates rise at paces faster than they did before the 2008 financial crisis. Mostly in commercial real estate, but commercial real estate includes multifamily homes, includes rent payers, includes office space, it includes a lot of spaces where leases are coming up for releasing, where those spaces don't have people in them, they're not making the money, they're not going to re-up those leases, and there's a tremendous amount of possible pain that will be coming into the regional banking sector, and so I just wouldn't touch any of that.
So Nomi, thank you so much for coming on to Metals and Miners and for being so generous with your time, your analysis, and ideas. It's been wonderful to spend this time with you. Would you please share with the viewers what's the overall theme you want to leave with them? Where can they learn more about your work, and how can they connect with you?
Yeah, thank you. So I also launched a Substack recently, and we recommend Metals and Miners as well. So I appreciate all the information that you have and the folks you reach out to. Mine is Prinsights.substack.com, and that's where I'm providing analysis both on a free basis and on a very discounted premium basis, boots on the ground analysis through mines, through the central banks, and also through the DNC, which is coming up. So if anyone wants to get a real glimpse as to what really goes on, it's not on CNN, you can come with me on there for that.
Wonderful. I'm going to be putting all of that information up on the screen for everyone to follow. If you don't follow Nomi right now or pay attention to what she's sharing, you need to. You don't know what you're missing out on. She is super intelligent, super articulate, super in the know, super connected. You want to follow Nomi. So Nomi, thank you so much for being here. I look forward to having you back on. And everybody else, thank you for watching.
Thank you.
Been an incredible conversation, Nomi. Before we wrap up here and I ask you our final question, I just want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us.